Hi traders, and welcome back to the resumption of the weekly video blog. Many apologies for the lack of blogs over the last month or so and the fact that the website's been down. I made the fatal mistake of thinking I knew how to code and develop websites. Sadly, that turned out not to be the case, and I had to call back in the experts to fix what I had broken. So it goes to show that as much as you think you can do things, often it's just best left to the experts, or to at least learn from the experts first before doing anything. It reminds me of when I first started in trading. Again, a little bit cocky, a little bit arrogant, thinking I could do it myself, and months later you realise that no, the most efficient route is to go and spend time with the experts. So apologies about that, but we're back up and running again, so touch wood, nothing goes wrong over the next few weeks and months, and everything's nice and seamless. So today what we're going to go through is the subject of horizontal levels. Again, purely based on demand from yourselves. I want to try and deliver webinars and videos that are relevant to what you need help on, or advice on, or education on. So based on the majority of you asking for further guidance on horizontal levels, that's what we're going to go through today. We're going to kick off with the dollar yen, and the main reason for that is because it has been of late one of the best reactors to horizontal levels out of all the currency, commodities, and indices. So it's a good example to use, and also want to make it relevant as well. This was one of the trades that I sent out on the text alert service, which resulted in a nice healthy 119 pip return. So wanted to make it relevant on that front, as well as going through the topic itself. So horizontal levels, why are they useful to us as traders? Why are they powerful? Well, the key thing is that you can't trick horizontal levels. You can't have a trick of the mind. You can't have a trick of the eye. They are what they are. They do exactly what they say on the tin. They're a level which occurs at a horizontal price point, and we see reactions to this horizontal price point purely because traders are trading off them, either as support if that horizontal level is underneath the price, or resistance if that horizontal level is above the price. Now, before I start, I'm sure the questions will always arise, is how do you pick the perfect horizontal? And even to this day, I will never be able to pick the perfect horizontal for every single opportunity. All you're looking to do is find a zone where price has reacted to a horizontal price point on several occasions. It's never going to be perfect, but you don't have to get it perfect, because what you're going to look for as well is that you're going to look for a reaction from price when it gets into a horizontal price zone. You're not just going to trade blind. You're going to trade once price gets into there and gives you a reaction that gives you confidence that the market's going to bounce from support or resistance. So as we can see here, I've got a couple of lines marked on, and this is just my eye that's tuned in and found the most points where the market has reacted and turned in the opposite direction. So as we can see here, the market reacted, broke a little bit below, and then pushed back higher. Here, reacted as support, pushed higher. Here, reacted as support, pushed higher. Here, fell a little bit short, but here again, we saw price react to support and push higher, react to support, push higher, react to support, and push higher. This was actually the trade that we took recently that I sent out, was this reaction to support here, where we saw this really nice move to the upside. I actually took it on an intraday basis to improve the reward to risk, thus the reason why we were able to net a 100+ return on that trade, and took it all the way back up to this opposite level, which was the resistance level, which we can see was resistance here, broke through here, but then became resistance again, and then became resistance again. Now, am I worried that it's broken in the previous occasions? Well, that could potentially happen, but more often than not, when a break happens, it breaks convincingly, and there's no sign that the market wants to turn. So as you can see here, the actual price bar, or the price candle that broke through, closes right at the top of the bar. There's no clue that the market or the sellers are coming back in there. Here, we can see that again, the market closed right towards the top of the candle, indicating that the bulls are still dominant here, and there's no likelihood of a reversal. However, here, look at what do we notice with the bar? High test, pushes higher, rejects, comes all the way back down. Here we get the reversal seller bar and then the market falls. Here we get the lovely inside high test bar and then the market falls. So more often than not, you get a price indication confirming that a reaction will take place at a horizontal level. It doesn't always happen that way, but more often than not, that will be the case, and that will give you the further confidence to trade off a level of support or resistance. So we saw the high test bars in the resistance. Do we get low test bars on the support? The opposite scenario. Well, we see one here. We see one here. We see an inside bar here, and we see a reversal buyer bar just here. So there's always a clue in terms of the price action in and around these zones that suggests that the market wants to actually react to those levels. Now, the reason why we get such strong reactions is you get a lot of the big institutions, a lot of the big banks, a lot of traders that don't even use price charts. They will just trade off horizontal levels, big price numbers, so the big round numbers where a price will end in 0.00 or 0.50, and they'll trade off those big levels there. So that's why you get such strong reactions. Also because horizontal levels are a little bit clearer than trend lines. They're a little bit clearer than moving averages because they're fixed. They're not a dynamic moving object. So they're a little bit easier for traders to spot and trade from. So very, very, very powerful stuff. Again, you get better over time. When I first started drawing horizontals, I was literally drawing them everywhere, but with time you get used to the ones that are the stronger versus the ones that aren't. So for me, this one down here is very, very strong because it's got the most reactions along the horizontal price point. Here it's got the most reactions to the horizontal price point. If I was to draw another one on and it had fewer reactions, I'd simply take it off. I want to find and select those horizontal levels that are at the big key levels and have the most reactions to them. So that's the Japanese yen. Again, you've got a couple of price points here down at the 101.20 and just up here at the 102 level, which I like because it's 102.00, big round number. So you've got a couple of price points to then look for trading opportunities. The only downside with trading off the daily chart is because these two levels are so close together, then it starts to diminish your reward to risk. So if you're trading here, the reward potential isn't that great. Thus the reason why the trade that I sent out recently on the alert service was an intraday trade looking at a lower time frame where I was able to enhance and improve the reward to risk to make it a worthwhile trade. So just bear that in mind. If your two levels are so close together that you can't get a decent reward to risk of 2 to 1 or greater, it's really not worth taking the trade. So you'll find these on a variety of other currency pairs. You'll find them on the daily chart are the strongest, and the lower the time frame you go down, the weaker they become. So just bear that in mind as well. But you'll find them on all currency pairs, respecting at certain times, not respecting at others. The Kiwi, as you can see here, I've already marked my levels on. Here at the big 8700 level, we saw some lovely reactions of resistance here. Here at the 8520 level, we saw some lovely reactions to support here, and also it responded here. Once it broke through, it became resistance. So you'll find that your horizontal levels will be either support and resistance at any one particular time, and if they get broken, more often than not they become the opposite. So if support gets broken, it then becomes resistance. So here we get support broken, then becomes resistance. Here support gets broken and then becomes a little bit of resistance with this high test bar here. And vice versa. Resistance gets broken, it then often becomes support. So we can use them in two scenarios. So we've got the 85 level and we've got the 84 level, which is 8400 level, which is a level that I'm keeping my eye on closely because we can zoom back in time and we can see that's quite a significant level here. Resistance, 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 support, and then it's popping back down. So potentially there could be a nice decent setup if it comes down into this 8400 level. So I'll be watching that very closely indeed over the next few bars, next few days, because it's very, very powerful stuff. And what you tend to find is if you are able to take advantage of these key reactions, more often than not you get a very healthy reward to risk. Not always, but more often than not you get a very healthy reward to risk, which will cover those trades where the market gives you a false signal at a horizontal level and doesn't follow through and actually stops you out. So again, horizontal levels again will never be the holy grail, as everything really in trading. Nothing is the holy grail. It's just a combination of factors, technical clues that gives you a high probability of success that over a long period of time most of your trades result in a profit, and those profits are bigger than the losing trades, and that equates to profitability. So again, don't think horizontal levels are the holy grail. They're not. They're a powerful tool in combination with some other factors that you can use to become a profitable trader. And again, like anything, practice makes perfect. You might find that you're finding it hard to spot these horizontals, but time on the charts, get on the charts, go back through them, draw your lines on, take them off, draw them on, take them off, because that will tune your eyes into the market and get you very well versed at spotting these key horizontal levels. So that's the Kiwi example. Again, you can go through all the currency pairs and you can practice, you can find them and you can use them to trade off. It's the same for indices. So if we pick, let's have a look at the FTSE 100. Again, we'd be looking for key levels of resistance and support. So again, your eyes, even without any levels on, I can see that there was a reaction here. There was a reaction here. There was a reaction here. All what looks like a very similar level. So I can pop my level on, and I can see that that is a pretty significant level of resistance that the market is likely to react to in the future, either as a resistance to hold it down, or if it breaks, to then potentially use it as support. Down at the bottom, I can see some levels just here, where there was some very significant buying. So there's some significant buying here, some significant buying here, so I'll be watching that one again, and I can see that there's quite a nice wide range to potentially take an opportunity from. I know we looked at these opportunities in previous videos, but look at the reward potential you've got off them. This one here, it's easily looking at trading a pivotal opportunity at the bottom here, would return you quite comfortably 3, 4, 5%. This one here, 5, 6%. So when you consider those, you can see how powerful it is. And look at the opposite scenario. So if you're looking for a short opportunity off resistance, here, again, 3, 4%, here, 3, 4%. You can see that just on this one asset class, yes, you do need to wait for price to get to down here and up here, but it's more than worth the wait. Just these 3 or 4 trades that we've identified, or these setups that we've identified, would have given you a fantastic return for a 12-month period, just on one asset class. Combine that with your currencies, combine that with your commodities, and you're looking at a decent return there. So very powerful stuff. So the work that you put in up front, being good at spotting horizontals, will be handsomely rewarded over the long term when you become good at trading from them, in combination with your price action, in combination with your other indicators, in combination with your strategies. And if you're then able to benefit from some intraday trades where you're getting into these daily horizontal levels but on a lower time frame, you're going to enhance your reward to risk even more, which is the great thing about trading, that it have several time frames that you can trade from. I've always been a big fan of the daily charts as an analysis time frame, but then execution, we can look at some lower time frames to improve our trading. And on future videos, I know a lot of you have been asking me about what time frames do I prefer. I'm going to do another video on that as well, so we'll look at time frames and the pros and cons of each one, and what you should personally look for in terms of your own strategy, in terms of what time frames, because your own personality, your own lifestyle should dictate which time frames will be beneficial to you. So let's finish with looking at horizontals on, let's say, a commodity. So let's have a look at crude oil. So I've already got one previously marked on. So resistance, 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 finally breaks through, resistance on the way down, just here. So we can see that it got broke as support didn't hold, broke, used it as resistance. Again, we can use our fib tools in here as another combination. So drawing from the top to the bottom just there, bang, right against the 618, in line with that beautiful horizontal, and we've got a number of different factors all coming together to give us a high probability of success. So we can see here there was a nice resistance here that we can trade off, and the great thing is, if we look at our charts now, look at this beautiful level. There is your reference point for months and months and months to come. That's not to say it will be reacted to in the next week or so, but you've got your level on, you keep it on, you don't need to take it off so long as it remains a very significant level. Leave it on. You have your reference point for months to come, and when price gets back up into that zone, you'll already have it marked on and you'll already be able to execute that trade. So very powerful stuff, and again, for those of you already using them, you already realize that. For those of you who haven't quite mastered horizontals, I urge you, practice makes perfect. Get stuck in, get those horizontals on your charts, and you may even just want to watch and see how price reacts to them initially, and once you see and build your belief system and you see how well price reacts to them and responds to them, then you can start to act upon them with real money. So hope this has helped. Pretty short, sharp, and to the point, but that's what I want to keep the videos. I don't want them to be long and drawn out. I want them to be manageable so that you can enjoy some quick, powerful content over the weekend before the trading week starts. So I'll wrap up there. I wish you a very successful and prosperous trading week, and we'll speak soon, no doubt. All the best.